Welcome to the latest episode of The Financial Frontier. I'm your host, Patrick Camuso. I'm joined today by a returning guest, Andrew Gordon, managing partner at Gordon Law Group and founder of Main Street Crypto PAC. Andrew was on the show last fall when we were discussing crypto tax reform, along with our anticipations on Form 1099-DA as we were heading into year one filing season. Now we're back today on the other side of the initial tax deadline with the extension deadline still ahead of us. We're going to take a look back on how that went, as well as discuss where tax reform for digital assets stands today. So Andrew, welcome back to the Financial Frontier.
Thank you, Patrick. Excited to be here.
Absolutely. So we both just came through year one of 1099-DA filings. From your seat, what has defined that tax season so far? What have you been seeing in your practice? What's went better than expected? And where is the most friction been?
Yeah, I think we all expected a bit of a mess when it comes to 1099-DAs. This is the first year that 1099-DAs are being issued to taxpayers, and many of them were late, some of them at the final days before the tax deadline, and also just still quite a bit of confusion about them. We have clients that very often will look at their 1099-DAs, see cost basis that's reported on it, and think that that information is going to the IRS and freak out, saying that their 1099-DAs are incorrect. For tax year 2025, although that information is included on a lot of these 1099-DA forms, the cost basis isn't actually being shared with the IRS, which is good in the sense that the information on there that's wrong isn't getting in the IRS's hands, but it's bad also because now we've got 1099-DAs that just show proceeds, that the IRS is learning about proceeds, the amount that you've sold it for, but they don't have your cost basis. And so it remains on the taxpayers, on us as the CPAs, to figure out what exactly is the cost basis, what should be reported, what are the gains and losses. So it was a year of some turmoil, some confusion. I'm hoping that things will get better over time. But for now, 1099-DAs are a bit of a problem for many of the people that I've been seeing.
Yeah, there's significant implementation challenges. And like you said, hopefully this over time, we'll see more information get phased in. And at least for, taxpayers with simpler activity, maybe it can create some ease for them. But there's still, we saw some late 1099-DAs, like you said, and we still have the challenges of collecting the taxpayer cost basis information between the taxpayers and exchanges, and then them even exchanging that between exchanges as we start to see, further phases of this reporting into future tax years. So there's a lot of challenges ahead for both taxpayers and brokers, and it all comes down to the biggest challenge in digital asset taxation is the cost basis substantiation, which me and you both know all too well. So another point that is widely discussed here on the Financial Frontier, as well as just widely across the industry, is the anticipation of what is it going to look like now that the IRS has this third-party reporting to compare and match against taxpayer reporting. Some are expecting a slower ramp up for enforcement based off of these implementation challenges, resource constraints, political headwinds, among other things, while others are expecting a quicker ramp up. So where do you land between those two camps?
Well, I think what we've seen historically is that the IRS will use whatever information that they have to move towards audits or enforcement. And historically, the IRS has had quite limited information about crypto taxpayers. They were receiving information through something called a John Doe summons, or actually a formal request to exchanges to share certain types of information if you hit a certain threshold of trading activity, for instance, in certain years. And those were very formal requests, and some of the exchanges even disputed them for several years. So that was one way the IRS got information. Also, over the last couple of years, with the absence of clear rules on how exactly to report on tax forms, some exchanges were issuing 1099-Bs, which are typically used for stocks or securities. We've seen several exchanges that use that for crypto activity, reporting then to the IRS certain trades, even things like stable coins, seeing them on 1099-Bs, which is quite frankly absurd that you're having to reconcile stable coins and figuring out your taxable gains. So there have been a long period of time where the IRS has had very little information voluntarily from exchanges or brokers. Now with 1099 DAs being required, any US broker or exchange is required to send to the IRS information on all of the trades, any of the sales, exchanges that are occurring on their platform by US taxpayers, really with no threshold, where in John Doe summonses, there's, for instance, a $20,000 threshold. Here with 1099 DAs, there really isn't one. What I would expect the IRS to do is what we've seen them do every time they get this type of data. The first is likely just issuing notices. If your tax return doesn't match the information that's reported to them, it's very easy for the IRS's computers. It's been very easy for the last 10 years. Now add in AI and all the other modern tools, and the IRS can see and compare what was actually reported on your return versus on the 1099 DAs. And if there is a mismatch or a discrepancy between the two, I would expect at a minimum that you're going to be receiving an IRS notice or letter asking you to explain or even sometimes proposing a tax due. Now, many people don't regard this as an audit, but it actually is, in fact, a type of audit where the IRS is scrutinizing what's actually on your return. So that's kind of the first level, which is a notice or a letter from the IRS. But we've also seen that the IRS has stepped up enforcement on crypto audits. Our team every day is working with taxpayers to defend crypto tax audits. In the crypto industry for the last decade, there's been this moniker of regulation by enforcement. And I think that there's no better example than in the IRS and the tax field, where we're seeing audits continue to happen despite the IRS not having clear rules. Certain types of trades or activity, they don't know whether it's taxable or not, aren't issuing guidance, but they're auditing and taking the most conservative or aggressive positions on these types of transactions. So I would anticipate that we're going to see more of the same. We're going to see more of it, especially now with 1099 DAs being issued and the IRS having this information. Another reason, too, is there's a lot of discussion on the Hill about the tax gap, and specifically the crypto tax gap, which is the difference between what's actually owed to the IRS versus what's being reported and collected. And we all know it's no surprise to the listeners out there that there's a tax gap, especially with crypto. People are doing their best to report, many of us. Some of us aren't reporting at all. Some of us are just reporting what the exchanges tell us, but there's certainly a tax gap in the crypto industry on what is being reported versus what is actually owed. The IRS knows this, Congress knows it. They're trying to shrink it. With better information, they can increase audits, try to close this gap. So I think for all of these reasons, it's all but certain that we're going to see more IRS activity in the coming years.
Yeah, the Form 1099 DA was designed to give the IRS this visibility, like you said, to close the tax gap. So that's definitely reasonable. Which brings me to something else, the historical digital asset form, which requires sworn disclosure across all of a taxpayer's activity, their wallets, and all of the exchanges that they used throughout all the years. And working in this space, doing the historical accounting and cost basis reconstruction, it is very difficult for taxpayers to even remember every wallet and every exchange that they used. Many are defunct. A lot of times taxpayers are lacking complete records. So this is a challenge now, not just for reconstructing the cost basis, but now dealing with this form if taxpayers are faced with responding to it. So how should practitioners and taxpayers both be approaching dealing with this form if they are faced with having to respond to it?
So if you get one of these forms, you should freak out. No, I'm joking. You shouldn't necessarily freak out, but you definitely want to call in a professional. And to take a step back and talk a little bit about what this form is, we've been representing clients in crypto audits for years, but in the last year, we've seen the IRS start to use a new form. They typically would ask, as part of the beginning of an audit, list out all the exchanges and wallets that you've used. List them out to the best of your ability. Taxpayers do their best to comply. We help them through that process. Now the IRS is sending out a form, a document that lists out every single exchange that you can think of, ones that have long been defunct, all different types of wallets. And next to it, they ask whether or not you had any activity from the beginning of your crypto activity all the way through the current audit year. So they're not just looking at the current audit year, they're going all the way back to the beginning. And they're next to each one, yes, no, checkbox. You've got to identify affirmatively whether or not you used it. This gives us a lot of concern as attorneys representing clients in audits. We do our best to try to remember several years back. Our clients do their best to remember what activity they had, but exchanges have come and gone. Maybe you tried something for a day and then you moved on. And now you've got to check yes or no, list the years you've used it. And the worst part is at the end of this form, you have to certify under penalties of perjury that it's true and correct. Now, this gives us all a lot of concern because what if you forget something? Can the IRS weaponize this form and say, well, now you're willful or even committed perjury because you didn't disclose something properly? So if you're out there and you're going through an audit and you've gotten this form, definitely make sure you reach out to counsel. Our team's been working deeply with this form, knows how best to respond, and often it doesn't make sense to actually comply and fill out the form. But there are ways to go about that where you're still respectful and cooperative with the audit while protecting your own rights. And I've talked about this form to people on the Hill, to the taxpayer advocate, and a lot of people are surprised that it even exists, right? We want the U.S. to be the crypto capital of the world. The crypto industry wants to pay their fair share of taxes. But when you have a form like this that basically puts them in between perjury and non-compliance, it puts you in a very difficult spot. And it's truly just not a fair form, right? You shouldn't be asking crypto investors or any taxpayer for that matter under penalties of perjury, going back all the way to the beginning for a lot of people, 10 years plus, to identify yes or no next to every single exchange that's pretty much existed. So we've been at the forefront of this issue. I think we were one of the first people to post about it, and we're continuing to follow it very closely because it's a dangerous form to say the least, and hopefully the IRS stops using it.
Yeah. Now, the structural reality is, though, is like the IRS needs that data to reconstruct the cost basis. But the trouble is for taxpayers is that it is very difficult with that level of historical activity to remember all this information. So that is really where the struggle is. And it kind of brings me to my next point, because you have called for a crypto voluntary disclosure program and a streamlined non-willful program in some of your comments to the IRS. Can you outline a little bit, why does crypto need its own path, and what should that program actually look like?
Yeah, as I've been on the Hill for the last year, 2 years, meeting with different offices, staff, different groups, administrative groups, the IRS, Treasury, this is perhaps the most important need that I think the crypto industry has. There's a lot of discussion about things like de minimis and no tax on mining and staking. And don't get me wrong, those are great things. But what impacts the everyday crypto investor? What impacts the people that we work with every day? We get calls every day, no exaggeration. And I'm sure you do as well, Patrick, from people who have not reported crypto in the past. They're now learning of the rules, want to come into compliance, and are afraid. In fact, there was a recent Coinbase report that came out that said 49% of people don't know that crypto to crypto is taxable. And this came out a couple months ago. This isn't some 2022 report. In 2026, 49% of people don't know crypto to crypto is taxable. Maybe you're watching this and realizing, well, what's he talking about? It's not taxable. Well, it is, but a lot of people are just coming to learn this. They don't know the rules. There hasn't been clear guidance from the IRS. The IRS has released maybe 10 different documents over the last 10 years about crypto taxes, despite millions of crypto investors being out there. We want clear rules. We want to understand what it is. We want to report, but a lot of people just haven't known what those rules are. So there's a very large population of people, those that we help, and Patrick, you help as well, that are now wanting to come forward. But a lot of them have fear. They call us because they've lost sleep. No exaggeration. They're not sleeping because they haven't reported crypto on their taxes in the past. They're worried if they do, they're going to get audited. They're worried if they don't, they're going to have a knock on the door from the IRS. That's not a good place to be. There needs to be a way forward for taxpayers, especially those that are non-willful, those that didn't know of all of these requirements, now coming to learn it, and they want to come forward. How far back do you go? What's the statute? Are you going to get penalized? There needs to be a way that they can come forward, a formal program, which would raise billions of dollars for the U.S. government, close that tax gap that we talked about, but also allow the crypto industry to comply without fear, not worried that if they start reporting, they're going to get audited. And truthfully, we see that happen all the time. People that do their best to report now getting audited. And those audits are not fun. We've got a client now going through an audit. The IRS thought he owed $80 million. not even close, right? I mean, it was just absolutely absurd. And he's thinking to himself, is my life, my financial future wiped out because of this, because of these wrong numbers? We need a program based on precedent. And this isn't something that I'm just dreaming up for the crypto industry. I am, but it's got precedent because in the past, the IRS was faced with similar issues with foreign bank accounts and foreign assets. There weren't clear rules 20 years ago about your Swiss bank account and whether or not you had to disclose that. A lot of people didn't know those rules. The IRS and Treasury implemented new forms, new rules. People weren't reporting. They weren't paying taxes on their interest and dividends in their foreign bank accounts. So the IRS said, you know what? We recognize that there's this gap between education and compliance. We've got these new forms and new rules. We need a program where people can come forward, report, do things the right way, not be in fear. And in fact, there's even amnesty programs in the past where you could have lesser penalties. And that's exactly, or no penalties. And that's exactly what we want to see for the crypto industry, where they're not in fear of audit, criminal investigations, but also big win for the crypto industry, not face penalties in perhaps a short term or less penalties, significantly less than what you would get assessed by filing amended tax returns or original tax returns late. Because those penalties, even if you're reporting the proper tax, those penalties can be significant, 75% a year. In some cases, they could add up to. And that in itself is a big deterrent to people reporting and again, can wipe out your financial future. So what we'd like to see is a program where these non-willful people can come forward. Perhaps in the first year, have full amnesty, no penalties. Got to pay your tax. Always got to pay your tax in America. But there's no penalties during that period. And then thereafter, lesser penalties. That's much less than what would typically tack on with filing late or having a difference on your tax return. The other big issue is look back period. We have clients come to us, they haven't reported crypto since 2014 on their taxes. How far do you go back? The typical statute is 3 years for audit, 6 years if you've got an understatement of 25% or more. And the problem is with the crypto industry, especially, the IRS thinks you often have these massive understatements when you really don't. So the IRS can go back 6 years, sometimes even longer, because if you were part of one of those John Doe summonses, the IRS actually extends the statute for however long it took the exchange to report. In the case of Poloniex, we've come to learn through a FOIA request, that's about 3.5 years that they took to report. So if you were trading on Poloniex, you have an extra 3.5 years tacked onto your statute. So what we're seeking is a limited look back period, specifically 3 years that you'd have to go back and amend your taxes. This is also beneficial and makes sense because with crypto, exchanges come and go. Even the biggest ones, and I'm not going to name names, but some of the biggest ones have disappeared pretty much overnight. And with that, often the records that they have, it's impossible to get a lot of your transaction data from some of these exchanges. And so if the IRS is requiring you to go back 6 years or however long, where's this data going to come from? Those numbers are going to be very inaccurate. So what we're seeking is for those that didn't know the rules, that they only have to go back 3 years and file those amended returns. Now, if you were willful, right? If you knew that you had to report crypto and you just didn't, which candidly is very few to almost none of the people we talk to. Sometimes they misunderstood the rules, but that still is not willful. That this shouldn't necessarily apply, or there should be higher penalties in those cases, because you still want them to come forward, you still want them to report, but there should at least be higher penalties there. So from my perspective, the people I talk to every day that are going through this is a win-win. It makes sense. It's a win for the government. You can close that tax gap, bring people into compliance, win for the industry, provide some clarity on how far you've got to go back, reduce penalties, alleviate the concerns about audits and especially criminal investigations. People have been prosecuted. My former client, John McAfee, he was charged with tax crimes back years ago. Crazy how many years ago that was, because he didn't report crypto on his taxes properly. We can't all see those stories, be in fear. It's just a bad situation for everyone. And that's why we think a crypto voluntary disclosure makes a lot of sense and needs to be implemented right away before the next tax season. As we go into next tax year, where 1099 DAs are supposed to include cost basis. I say supposed to because who knows if they're actually going to be correct and if they're going to be sent on time. But the IRS is going to be getting all of this information, potentially weaponizing it towards audits or investigations. So we need, before that happens, a way for everyone to come forward.
Now, you've also called for reform on crypto scam loss treatment. How do you see that actually getting done? And what is the outlook on that from your perspective? And can you speak to a little bit for what's really at stake for taxpayers when it comes to this?
Yeah, crypto scams are horrendous, and they also happen all the time, especially those referred to as pig slaughter scams, which is a very common scam. If you haven't been a victim of it and you're watching, you know someone that's been a victim of a pig slaughter scam. They're incredibly prevalent, and the worst part is the government seems unable to stop them. They're originating from other countries, and they're just continually ongoing. In these scams, people believe that they're investing in something. They believe that their investment is going up, so they keep putting more in. They're the scammers are playing to greed, where people think that they're doing well and want to invest more. And so we have clients and we talk to people who have liquidated their bank accounts, sold their homes, cashed out their retirement, and now they learn that it's actually all a scam. They have nothing left from the scam, but the worst part of it all is they're also getting hit with a tax bill. I mean, it's truly adding insult to injury here. The IRS, yes, we want them to collect their taxes, but if you've withdrawn from your retirement account, you'll typically have income tax on that. If you're under the retirement age, you'll have an additional penalty. So if you've cleared that out and fed it to a scam, you've got no money, and now you're getting hit with a tax bill. This, historically, there have been solutions in the past for this. There used to be a theft loss deduction that you used to be able to take before 2017. And with that, you could take a deduction for anything that was stolen from you. That went away. There was also a Ponzi scheme deduction. Still applies. Congress, rightfully so, back in the Madoff days, I'm at least old enough to remember the Madoff Ponzi scheme, but back then, there was a massive scheme, and it cost people billions of dollars, which actually pales in comparison to the pig slaughter scams that are happening today. And they stepped in and said, we need a safe harbor. We need a deduction for people that are victims of this to take a deduction on their taxes. Those things exist, but they don't really apply to crypto pig slaughter scams. First, the theft loss deduction is gone. Secondly, for a Ponzi scheme deduction, you need to be able to identify the wrongdoer. And in many cases, there actually needs to be criminal charges. With these pig slaughter scams, they're happening from Cambodia or some faraway country. You're never going to find the person that did it. They're long gone. They're never going to be brought here or indicted. I hate to break the news to many of these people, but you're unlikely to actually recover your money. So the Ponzi scheme deduction doesn't really fit. We need a new deduction that takes into consideration this exact issue, that people are clearing out their retirement accounts or other accounts, getting hit with taxes, which, the IRS, again, they should collect their taxes, but you shouldn't penalize the victims even further. And this has been a topic that I've been discussing quite a bit on the Hill, both sides. So these are issues that should be bipartisan, both the crypto VDP and scam loss deduction. You see a lot of discussion on X and social media about other bills and how partisan they are. But these are things that really shouldn't be partisan. Unfortunately, I've been having discussions with both sides of the aisle, because this is about the everyday taxpayer. It's not about big businesses. It's not about the big crypto exchanges. These are things that are impacting all the people that are watching this, all the people that you and I serve every day. So I've been fighting, and I'm going to continue to fight for these two areas. But a crypto scam, I'm very hopeful that in coming months, we'll see legislation that addresses this issue.
Yeah, these types of scams are devastating people financially, and it is a brutal conversation when you have to explain the tax implications to them. Because like you said, it is just, a whole nother layer of financial burden for them to deal with. So we will be tracking that closely. Now, on the legislative side overall, on the digital asset tax front, things are moving quickly, and I know that you're on top of this. Across the different tax bills, where are you seeing the most consensus overall on the substantive provisions, and where is the most meaningful disagreement still?
Yeah, overall, there seems to be consensus that we need clarity. We need rules, right? We need Congress to step in, force Treasury to define certain types of transactions, have laws on the tax treatment of things. There are some that are more controversial than others. We saw recently the Parity Act, which was introduced, a bipartisan bill in the House that addressed things like mining, staking, validator type rewards. also address the issue of stable coins. Another just absolutely absurd thing that we've seen, we've actually had to bring to tax court a client who sold stable coins, didn't report them on their taxes, and then the IRS sent them a bill. Now, it doesn't take a genius to know stable coins are generally pegged to $1. You don't have to be a crypto expert to understand stable coins are $1. But for some reason, the IRS, in our client's case, thought that there was no cost basis, that it's zero. Sure, it may fluctuate a penny here and there, but they thought it was zero. So we actually had to take this to tax court before the IRS eventually conceded. And that's an issue that we're seeing a lot of agreement, a lot of consensus on the Hill that stable coins, especially those that are genius compliant, the new legislation passed almost 2 years ago now, that there shouldn't be tax reporting. Another one that's a bit more controversial is a de minimis exception, small dollar transactions, whether those should be exempt from reporting. Another one that's less controversial is qualified appraisal requirements for charitable donations. We've had clients that donate Bitcoin or other digital assets to charities. And we had one client, he donated about $500,000 of Bitcoin to a charity, and the IRS audited him, disallowed it in full, because he didn't have what's referred to as a qualified appraisal. He didn't have a CPA or a professional come and determine what the Bitcoin was worth. Instead, he used the trading price on that day to identify what his deduction is. And that's pretty logical. It's common sense. The IRS said no, citing a decades-old rule that you have to value anything that's not a stock. Now, stocks, if you donate that, you get to use the trading price. Well, with digital assets and crypto, you have to have an appraisal. Absolutely absurd. And so we're seeing a lot of agreement on that issue too, where if it's a digital asset that's traded on an exchange, a large market cap digital asset, you shouldn't have to get a qualified appraisal. You shouldn't have to fight an audit that tries to disallow that. So that's another one too. I'm very happy to say that the Parity Act, bipartisan bill, Representative Max Miller, Representative Horsford, that included the first of its kind, a mention about a crypto voluntary disclosure program. In it, it actually requires that Treasury do a study on the feasibility of a crypto VDP. It's the first time that's ever been mentioned in legislation, which we view as a huge accomplishment, a huge step forward, but we need to go all the way. The studies are great. They take time though, right? We can't wait a year, 2 years for the Treasury to say, yeah, this is a good idea. It's a good idea. And so we're hopeful that more legislation will continue or that revisions will happen to this. Hasn't passed yet. Parity Act is just going through the House now. There's more crypto tax legislation on its way. Talk to different committees, the Ways and Means Committee, which is holding a hearing next week. And it's anticipated that they're going to have some draft legislation. Senate Finance Committee is also actively involved. And you all may remember from Schoolhouse Rock, I had to rewatch it before I started going to DC, but you all may remember that bills start in committee, then they get passed, and then they go to the full House or Senate for a vote. So these are the two gatekeepers for crypto tax legislation. The Senate Finance Committee, House Ways and Means, on their respective sides, those are the committees where tax legislation generally originates and has to pass before it goes forward. So we're seeing that both of these committees, and I've had several meetings with both of them, Democrats and Republicans, to talk about crypto taxes. They're engaged. They understand that this is an issue. And finally, I've met with people in the White House as well, and it is an executive priority to address crypto taxes. I love crypto tax. Patrick, you love crypto tax. But guess what? The White House also loves crypto taxes and understands that it needs to be fixed. And it's been said by basically everyone I met with on the Hill that once we get done with clarity, which is the legislation about market structure, that the next focus is crypto taxes.
Very nice. Very nice. Now, two things that are thrown around a lot in legislation that you've mentioned here, but also just for, the better part of this industry's existence is applying wash sales to digital assets and the timing of the recognition of staking. And on the staking, there's a legislative side to this. And then there's also the side that is, there's multiple court cases, one that everyone's discussing today that, we may want to touch on here. But I want to hear your take on this. Obviously, there has to be trade-offs between tax revenue and loss of tax revenue whenever we're looking at legislation. And the U.S. also has to stay competitive and attract validators and other market participants to the US. So what I see a lot of times is this trade-off between wash sales and staking. To a certain degree, it can create different, winners and losers in the market. Obviously, the stakers benefit from simpler year-end record keeping with the deferral, as well as a meaningful tax optionality. And active investors would face wash sales rules, which add tracking complexity. Plus, of course, a 61-day window and in a market that trades continuously with a large degree of validity. So how do you see this shaping up and playing out across the ecosystem?
Yeah, and these have been some of the most common issues or areas of discussion, and also commonly included in a lot of the legislation that we've seen already on the Hill. One of the concepts that I hear come up time and time again when I meet with different offices is that we need parity, not the bill that I mentioned specifically, but we need an equivalent structure for other financial instruments as crypto. Stocks shouldn't be treated better than crypto. Crypto shouldn't be treated better than stocks. And as of now, crypto doesn't fall under the wash sale rules. The wash sale rules only apply to stocks and securities. So it's been a great tax loophole, tax break in the eyes of some, where you can trade your crypto, sell it at a loss, and buy it right back. Makes for great tax loss harvesting, but it doesn't fit other stocks or other financial instruments where stocks, you've got to wait a period of time before you could buy it back or that loss is disallowed. Now, it's been discussed often that the wash sale rule should apply to crypto. In fact, even in prior administrations, there were efforts to close this gap. Fortunately, it didn't pass, and the current efforts are trying to have some wins as part of that, where we're not just giving up the wash sale rule, but we're achieving some other things as well, such as deferral on mining and staking rewards. With wash sale rules, I think we have to be careful. I understand parity, I understand fairness, I understand closing loopholes, but crypto is different. It's traded 24/7. And also, as we've talked about almost this entire time, reporting crypto on your taxes is difficult. It's very complex. Most people don't even know how to do it. And now with a wash sale rule, you're going to have another layer of complexity. Every time you sell something at a loss, you're going to have to be running a clock to figure out, did you buy it back in a certain amount of time where it's covered under the wash sale rule? Are you outside of that? More complexity, more compliance costs in something that's already struggling with those two issues. So I think as that issue is legislated and potentially passed, there needs to be more attention to it. You don't see a lot of discussion on X and social media about the wash sale rule and some of the nuances with crypto. So I'm trying to be part of those discussions, trying to talk about some of those issues. Who exactly should be doing the reporting? How can we minimize that burden on the everyday taxpayer? Because I think that those concepts are important. Even if we have to close the loophole or apply some of those gains to other issues, we still need to be aware of some of those difficulties that are facing all of us, which often get lost on the people in DC, right? They're not the ones trading or working with clients every day. And that's why stories from all the people that we work with, we try to bring those stories to the Hill, sometimes bring our clients to the Hill as well, so they can share directly how complex this is, what the issues are that they're facing. So wash sale rules, I've seen it in many of the legislations that are advancing in DC. It's likely that that gap is going to be closed, if not this year, some point in the future. But if we're going to close that loophole, we might as well get some wins. And again, one of those potential wins is no tax on mining or staking until sold, or an election to do so. Some people want to pay their tax right away because they believe that in the future it's going to go up, and they'd rather pay their tax now than pay a long-term capital gain in the future when they sell. Other people, there's no liquidity. They're mining, staking, and they've got to sell a portion of it right away to pay their taxes. And I often analogize to other industries: fishing, conventional mining, creating artwork, right? You don't pay tax on those things till you sell it, till you got some cash in hand, then you can pay your taxes. So I think in terms of parity or fairness, that also makes sense. I'm very optimistic that we're going to see legislation that allows that deduction or that election to be made, that you don't have to pay taxes till later on. But Patrick, as you've mentioned, even recently, the last week in tax court, there was a ruling that said staking rewards were taxable as soon as they're sold. There was prior hope historically, because there haven't been a lot of these cases that actually go all the way to tax court, especially to a trial. I tell you, even in my own experience, we fight these issues, but usually there's an agreement made and appeals. And even if it goes to tax court, usually a settlement. Usually don't have a judge issuing a final determination. We had a case years ago, the Jarrett case, where the IRS basically withdrew their case. In the Jarrett case, it was about staking or validator rewards. And a lot of people view that as optimism, that maybe the IRS is backing down. We assess that case as less important because there's such a small dollar amount at issue that the IRS didn't want to roll the dice on a judge making a decision. So they backed down. It wasn't worth going to trial for the IRS. But a lot of people view that as maybe an indication that things could be different. There was a tax court ruling just this week, though, like I mentioned, and Patrick, you mentioned, that ruled that staking rewards were taxable. And I think that that's likely the case that tax court or the IRS will continue to argue unless we have legislation that fixes it.
And yeah, I agree with you with the optionality for staking, for taxpayers to be able to have an election and give them that flexibility, because there can be strategic tax benefits depending on how a specific taxpayer is situated. And overall, that case that came out, the memo 2026-46, it was at least just confined to the custodial staking rewards. So I think it is a bit limited, that case overall. But this kind of draws into, the wider, even on the wash sale side, right? What is going to be defined as substantially identical when you're start tracking for wash sales purposes, and how are you going to implement this in accounting systems and properly track cost basis when it's already been something that has been a challenge for the better part of a decade, with, well documented across practitioner voices, even academic studies, where there's large degrees of variability for the same set of transactions across different tax computation softwares that taxpayers even have to use. So this is going to add to that complexity, but there's going to be changes that have to get implemented. I see the momentum, and I know you see it as well. And, the combination of this increased transaction visibility that we're having in the US and that we're also going to see internationally, combined with the legislative aspect that's drawing new boundaries around the overall market and creating a new structure, it's really going to define what this industry looks like for the next decade. And it's something that taxpayers need to be thinking about strategically on how it impacts their company and their portfolio. But something that you focus on a lot as well is making sure that we have a voice in this and that we come to the table with reasonable positions that can lead to good outcomes. So with that being said, 12 months out from now, what should digital asset taxpayers be planning for, number one? And then also, what does meaningful legislative process look like from your perspective?
Yeah, well, I'm optimistic that 12 months from now, things are going to be very different than they are today. We have a fairly short window of opportunity. We've got an administration, love them or hate them, they're pro-crypto. They want to see things done and changed for crypto, especially crypto taxes. So that hasn't happened, right? We're living in this climate now, and we've almost gotten used to it, where the government isn't trying to kill crypto. But I remember a time before, and I'm sure, Patrick, you remember too, where the government was actively trying to kill crypto. There are many examples of this, even just trying to stop banking, or having tax laws like the ones that we're talking about that are very punitive towards crypto. So we have an opportunity for change, and that change can happen very quickly if we all push and work towards it. So that's what I've been doing. I've been spending a lot of time on the Hill in DC, meeting with lawmakers. Believe it or not, my day job is in the office working with taxpayers, but I understand that this is our shot. And if we don't take advantage of it, it can go very quickly. And I fear what legislation could look like in the future when we have a not crypto-friendly administration. So now is the time for us to try to push these things forward, support lawmakers, initiatives like ours who are trying to move the ball forward. And with that, I hope that in 12 months, we have kind of a pullback of some of the issues and laws that we're seeing now. If we don't, though, then 1099-DA reporting is going to be an absolute mess next year. Cost basis needs to be reported. I don't know what these exchanges are going to report. From what we've seen already, most of our clients that get these 1099-DAs, they call us screaming that the exchanges got it wrong, or even sending it out late. We've had exchanges that sent it out past the tax deadline, which, I mean, gosh, what are you supposed to do then, right? The IRS gets the form. If you don't match it, you're going to get potentially audited or a notice. So do you amend your return? What do you do? I mean, it's unfair. So I'm very hopeful that there will be changes, but if there's not, it's going to be worse before it gets better. But, years down the line, maybe 1099-DAs make it a lot simpler to report on your taxes. your crypto. But for now, it's making it a lot harder. And then also with so much ambiguity. Are wrapped tokens a taxable event? How do you address yield farming or liquidity pools? Even issues and NFTs have kind of fallen out of favor. You don't hear as many people talking about NFTs nowadays, but maybe they come back. And, are NFTs collectibles? There are just so many nuances to crypto taxes. And when we don't have clear rules, we're leaving that discretion towards enforcement. We don't want that. So 12 months from now, unless we take action, unless we support those that are fighting for these changes, I think it's going to be a more difficult climate than we have today.
So Andrew, I really appreciate this conversation. Where is the best place for taxpayers to get in contact with you if they want to work with your firm, but also for practitioners and even taxpayers to get in contact with you on the legislative side of things as well, if they want to maybe give some input or have their voice heard or have a story that they think belongs in, on the Hill with you? Can you give us the best places for that?
Yeah. And I want to hear everyone's stories. Those stories have been what has made the difference. I have gone from being in the office 7 days a week to spending quite a bit of time on the Hill, and fortunately been pretty effective in the meetings that we've been able to have. The doors have opened to us because of the stories. Not because they like me, maybe they do, maybe they don't, but it's because of the stories that we're able to share with them. The examples of taxpayers who are going through these experiences, how they're affected. We brought into some of these meetings maps of the US with dots for taxpayers in all of the different states where we can meet with representatives and say, hey, look, there are people in your state dealing with these issues. This isn't just a Gordon Law issue. This isn't just a Patrick issue. Everyone is facing these issues. So please message me, reach out with your story, how crypto taxes have impacted you. If you've gone through an audit and there's a negative result, gone through an audit and there's a good result, or you just even haven't reported crypto and you're in fear. I want to hear from you. I want to help elevate those stories, bring them to the people in DC because they want to listen. Believe it or not, the people in DC are often meeting with lobbyists, special interest groups, dare I say, even the big exchanges that are dominating the conversation. And it's often refreshing for them to hear from people that are actually going through it. So reach out to me. The best ways to do so, our website, gordonlaw.com. We're on all the different social medias. On X, it's @accounting. So just accounting is the best way. You can message me, follow us, repost our videos, because that's really what matters here. And I want to be in contact also with practitioners. The issues that are facing you may be different than the ones that I've been facing. So I want to hear from you as well. Let's have the discussion going. We're all on the same side. We want to have a win for crypto. We want to keep crypto in the United States. And there have been years where we've had countless clients stop trading crypto, move to other countries. That's not the country that I want to be in.
Yeah, so I encourage everyone to reach out to Andrew, get in contact with him, and follow him on social media. He puts out a ton of great content. And to everybody that's watching, I hope you took some value from this conversation. There's a lot of moving pieces when it comes to crypto tax that we need to continue to stay on top of, and that's what we're doing here at the Financial Frontier. So Andrew, thanks again for being a guest. Looking forward to having you back in the future when we maybe have some more legislative updates or more 1099 DA updates. Until next time, I'm Patrick Camuso, signing off.